I think you're going to be disappointed. Inflation runs at 4%, you get 3.5% in your bonds, you're losing money. Well, it sounds like inflation is going down. It sounds like there's good news. It was 9% last summer. Now it's only 7%. And a lot of people are assuming that we're on a rapid downward slope. 7 today, 6 in January. Pretty soon it'll be back to the 2% we're supposed to have.
Hope springs eternal.
Yes, and I think that's just a little too Pollyanna-ish.
Well, you go through a number of factors, but before we get to that, let me just start with the Consumer Price Index, CPI, just to kind of level set. Is that an accurate gauge to begin with of where prices are headed?
Well, it's the best we've got, and we depend on the Bureau of Labor Statistics to track hundreds, thousands of different things, the price of cottage cheese, the price of a movie ticket, and to add it all up and to weight it the right way. That's a tricky business there, because people's market baskets change over time. That gets complicated. And it's also complicated because quality changes. You really can't compare today's iPhone with the iPhone of 5 years ago.
Yeah.
If you did, you'd go crazy saying that today's iPhone has 5 times as many transistors in it. At any rate, the BLS does a very credible job, except on one thing.
What?
That, I think, is the cost of housing. And the reason that they struggle with this cost of housing is that it isn't simple. You can't just take the price of homes, which kind of shoot up during a pandemic boom, and don't necessarily represent an increase in the cost of living in a house. But whatever they're doing, I think they're undercounting it. And I think this is going to catch up with them. And when it does, we're going to see an upward push in the CPI. So right now, something that's called owner equivalent rent. That sounds very abstract, but that's 30% of the CPI. And what they're trying to do is say, if you own your home, which a lot of people do, then your cost of living includes what it means to live in that house.
Yep.
So you bought the house, you make mortgage payments, you got to pay to fix the roof, and got to pay your property taxes. How do you add all that up? And the BLS, the Bureau of Labor Statistics, has struggled with this for decades. They used to do it totally wrong. They used to look at mortgage payments when that number gets all screwed up because of the way interest rates change.
Right.
And the new system, I don't think, is a whole lot better. The new system extrapolates from what happens to rental properties, which I think are totally different. Oh, yes, China. Now, we've had a very happy 21st century so far with prices, or at least until a year ago. And one of the reasons we had happy stories and low inflation is that China was doing such a good job of dumping cheap manufactured goods on us. Umbrellas, iPhones, whatever it is, it always says made in China. And it was made in China by low-cost labor. Well, I think some of that good news is over. It could even reverse itself in the next decade. Let's just look at some of the reasons for that. You know that China is struggling with COVID and its lockdowns. They're trying to unlock down, but it's still a mess. The factories aren't really working very well. That's just one thing. And another thing, I think, is that the country is on the verge of running out of really cheap labor. There was a migration of people from very poor rural areas into city factories, and they came in and accepted low wages. Well, China has outgrown that stage of growth. China is not a point where all those people want to be in the middle class, and they want middle class wages. So we're still going to get goods manufactured in China, but they aren't going to be a screaming bargain anymore. No, that's still very much a possibility. Vietnam is obviously going to be a good place for us to get apparel, where it used to come from China. You know, this is all part of a progression. 50 years ago, the cheap labor and the cheap apparel was coming from Japan. Well, Japan migrated out of its post-war poverty into modern developed country economics. So Japan can't cheaply make shorts anymore. That had to go to China, and now China's not doing it. Maybe it goes to Vietnam. But the whole world is becoming more prosperous. So I don't think we have quite the same beneficial impact from cheap labor displacing American labor. We just don't get that benefit. It's going to go sideways.
Right. And do you think the political tensions between China and the U.S., Xi Jinping and now the Biden administration, is that also a factor in terms of costs?
Well, there's two things going on. One is that I think a lot of American manufacturers are having some uneasy feelings about leaving too much of their production in China. So if they have to spend more money to move it to Vietnam or even to Japan or Korea, they're going to have to spend that, and then you're going to see a higher price when you go to Walmart. That's one thing. I think the other thing is that we're seeing a dark side of Xi Jinping. I think of him as not a premier, but as the emperor. Kind of there for life, and he's taking on entrepreneurs. He's punishing them if they don't toe the line politically. And I think that means that there's going to be more migration of capital and talent out of China. And it's not going to be a great place for Apple or anybody else to do all their manufacturing. They'll do some, but they won't be able to do all of it there, the way Apple was until recently. Well, look around at all of the evidence of staffing shortages. I saw it when I waited for an hour to check one bag at Heathrow. You see it when you go to a restaurant and the service is really slow and the waiter finally shows up and said, sorry, we're short-staffed. I have to do twice as many tables tonight.
Yep.
There are a lot of places where you're seeing staff shortages. That's an excuse. I think it's a wrong excuse. It's a wrong economics. What's really happening is that that restaurant or that airline at Heathrow is not paying enough to get all the talent they need in the door. And they're eventually going to catch up to that reality. They're going to have to raise their wages. They're going to have to raise their menu prices to cover the wages. They're going to have to raise their airline ticket prices. And there's a lag here. There is a lag between the pandemic, the staffing shortage, and the final acceptance of reality. And the acceptance of reality is going to be higher wages, higher prices. You haven't seen the worst of it, or you haven't seen all of it. By the way, I don't think that the CPI is suddenly going to shoot up from 7 to 9 the way it was last summer. It's coming down. I just don't think it's coming down nearly as fast as almost everybody else seems to think it's going to come down. Well, everybody's saving for retirement. Do you have any money in bonds, Diane? You probably do. Look at your 401k. It probably has bonds in it. I have bonds. They're a safety feature. You don't want to put all your money in the stock market, which could crash tomorrow. But here's the downside. When you buy bonds, you're getting fairly crummy yields. The yields on high-quality bonds like U.S. Treasuries are now 3 to 4%. Well, inflation is already 7, right? Now, it's going to come down. What if it only comes down to 5? And you've got this 4% bond in your retirement. What are you really earning? You're really earning -1.
Right.
And so the moral here, I guess, is the CPI is not going to come down as fast as you think it is. It's not going to come down as fast as the bond market thinks it will. And the bond market's yields, what they're offering you is not very good compared to inflation over the next 10 years. You're going to get a little bit poorer if you own bonds. I start by looking at 2 Treasury yields, and you can go online and go to the U.S. Treasury Department and find these very quickly. If you look at the regular nominal bond yield, it's, as I say, it's around 3 to 4% for longer-term bonds. Then you can scroll down, and you could look at what do you get if you have inflation protection. And right now, it's around 1.3 to 1.5% yield. And it's the 1.3 to 1.5 that you could get if you bought inflation-protected bonds and you want to be conservative in your retirement and you bought those, you could be assured that you'll get your money back and then a little extra. And if you buy the other bonds, which seem to pay more, then I think you're going to be disappointed. Inflation runs at 4%, you get 3.5% in your bonds, you're losing money.